Saturday morning to you, and welcome to On the Mark, along with Mark Papa. I'm Gary Byron. You can check out Mark Papa at Financial Resources Group online at www.frplan.com. That's FR, that's Financial Resources Group, frplan.com. And by the way, you can call him to schedule a no-obligation consultation, 860-657-8380. Again, 860-657-8380. I will be repeating those points of contact throughout the show. And by the way, if you miss any part of this show, or perhaps some previous episodes, well, what you can do is one of two things. You can go right back onto Mark's website, frplan.com, and then look for the link over to YouTube. He's got his own YouTube page. This is really cool. Just type in Mark Papa, that's Mark with a K, and there's three P's, MarkPappa, Mark Papa 5207. And look for you'll be able to replay this show and any others that we have recorded in the past on his own YouTube channel. Very cool. Mark, good morning. Great to see you. Hi, great to see you, Gary. How are you? I'm doing well, but I was going to ask you, and people would already notice because they hear you, and you have a little bit of sounds like you're getting over a cold. You must be run down this time of year. I know we're out of tax season now, but leading up to, I mean, the last couple of weeks, or last week since I've seen you last, balls to the wall, full steam ahead. I mean...
Oh, yeah. It's been back-to-back appointments, back-to-back phone calls, back-to-back text.
Now you're run down.
It's time to relax under a palm tree somewhere. I just haven't booked the flight yet, and my passport has been renewed, and I'm ready to go somewhere. But, yeah, without a doubt, it's a long season, and I will be announcing publicly that my transition away from actually doing individual tax returns I'm probably going to limit, and most of what I want to do is tax consulting and tax advisory and helping people lower their tax bill, especially in their retirement, even as they're building their retirement. It is just a daunting task. And the unfortunate part, we're still at fairly record low interest rates, but the more successful, more tax rates, but the more successful you are, unfortunately, the more you're going to pay. So my bank account's not feeling all that great today. And I was able to file my taxes on time and had a very good year. And thankfully,
did you owe?
Oh, yeah. Well, the issue is in July of last year, I had sent in a nice estimated payment. I said, okay, this is going to cover about half my bill for the year. And I said, come tax time, I better be ready. And I couldn't find when I sent the estimated payment, so I was freaking out, going through all my bank statements. When was it sent? And I finally found it, put it in my tax return, and the sense of relief I had was amazing. So for anyone listening, if you do tend to have balanced dues, come see me because I know how to fix them. But also, whether it's adjusting your W-2s or adjusting your pension or taking money out of your Social Security, but also just finding ways to lower that tax bill. And I was able to do that because of my my deferred comp plan that I have. I'm a solo 401k. That was my saving grace. I was able to put away more money, and that helped lower my tax bill by a lot. So,
all right, so let me get something clear because I know you've got two businesses. You also are tax preparation. That's not the purpose of this show, but it's something that you do. Are you completely getting out of that area, that trade?
I'm going to be doing is I'm going to limit my action because I want to stay relevant in taxes because it's a huge part of people's retirement.
Yeah,
it's so important, and even saving a couple $1,000 a year is a lot to somebody on a fixed income. So I want to stay relevant. So I'm mostly going to be working with those people who are my firm's advisory clients, meaning we manage their funds, we manage their retirement, we structure their income plans. And by the way, we want to make sure, we have a saying is we're going to give you the most money with the least taxes and the lowest chance of running out. And that's exactly what I want to do. I just want to blend it all together. I'm definitely not going to be just pecking the keyboard anymore. It's just after 20 years, it's just become a little too much.
Yeah, and you're a pretty busy guy. Yes, it is.
Yeah.
You mentioned the stock market. You mentioned taxes. You mentioned there's volatility going on right now. You mentioned the interest. You mentioned interest rates, and I don't know if they're going to be. I think they're going to lower them probably by 0.25%, probably sometime in the next few weeks. And I'm no authority on this. I'm just trying to read the tea leaves here. Mm-hmm. You read Kiplinger, you read some Bloomberg, you read some of these magazines, you read the trends. I get the Wall Street Journal. I usually, I read it at home. Probably have one here actually somewhere. Are you looking at interest rates? What do you foresee? And I know you have no crystal ball. As a full disclaimer, just as a professional who reads the trends, what do you forecast?
At this stage of the game, given there's a lot of volatility in the market, but I don't feel that the Federal Reserve has the gumption to help Trump with these tariff policies. I don't think they like him. No economist likes tariffs. And I think that Trump is going to use them as a negotiating tool. And we're going to dig into this.
Smart? Is that a smart move?
That's a good question. Tariffs in general, I want fair trade for everybody, and I think that's what the president is really aiming for. I think he would like to have zero tariffs, and everyone had everybody was a free trading country. I think that some of our allies are quote unquote allies, especially the EU. It doesn't get brought up, but there are some really onerous regulations they've put on American companies in the name of climate change, or in the name of some other reason to tax our goods to protect their own industries. And I think perfect competition, there's no such thing, but competition is what makes everybody better. And I'm afraid tariffs, when you have a protection of policy, actually lowers your ability to make better products. Meaning, if I'm going to make a Ford truck, I'm not going to have to worry about that Toyota truck coming over the border so much, or that maybe a truck from China one day, because you know what, people are going to buy American whether it's good or not. And I think consumers need the choice. So I hate tariffs, by the way. I'm not a big fan.
But are they working? Because, you're hearing about Hyundai, you're hearing about other corporations that are either moving a plant into the United States. You hear about other nations that are making incredible investments, $500 billion from one,
right.
$250 billion from another. That's not chump change.
No, those are positives. That's the positive side of I think the fear of the tariff. That's but I'm more about the carrot than the stick. And it's one thing to say, hey, you know what, you're going to build a plant here in the United States. So where are you going to build it? Right? Are you going to build it? I think one of them was Louisiana. Of all places, I can't remember.
There's a few states. Yeah.
Where are you going to build it? And then let's say you are going to build it. You're going to build it in a place that has low-cost electricity, who has a good labor force, that has an educated population. There's property taxes aren't so high. So there's a lot of things that we need to change as a country as well, in order to accommodate some of this resurgence in manufacturing. And unfortunately, I don't think that our local governments are so quick to change, especially here in New England. I mean, God, they tax my desk, they tax my computers, they tax my chair. They want a piece of the action. And if they're not going to be kind, I don't see why it would make any sense for somebody to spend that kind of money without the right incentives.
So how did the implementation of sweeping tariffs in 2025, let's talk about particularly those that were announced on Liberation Day. How did that all contribute to the global stock market decline?
Well, it was a shock because Trump, in his announcement, took a lot more than people anticipated in terms of his tariff talk. And that really roiled global markets in a big way. But I want to make the point of this show that it wasn't just the tariffs as for the reason why the stock market sold off. There were so many other factors that the media had completely ignored up until that point, as a way, I think, they're not obviously Donald Trump's friend. And I'm not saying Trump is solely responsible for the sell-off either. I think tariffs helped push the market over the edge as something that was already poised to happen. So we had record high stock valuations. That was one issue. If you look at, let's say, the Shiller PE, which is a really interesting indicator we like to watch, or the Buffett indicator, those two were at nosebleed levels. I mean, we had very high valuations in the market, and it was definitely due for a sell-off. And I would even argue that the sell-off we just had is the sell-off we probably should have had in 2023. Now, why would I say that? Well, 2023, the entire market got bailed out by NVIDIA, right? NVIDIA, artificial intelligence, Microsoft, Meta, and AI spending. So it's like an arms race right now for artificial intelligence. And it was that spending, those 7 companies, which are called the Magnificent Seven, dominated the entire S&P 500, dominated the stock market, made up well over 30% of the index. So ask yourself this, Gary. You want to be diversified. I'm going to be in the S&P 500, but I have 7 companies that have basically made over 50% of the return of that index in 2023. That meant the other bottom 490, there were companies that actually were growing faster and better than those 7 companies that were literally ignored. And that was a big argument that, we would be on conference calls with some of our investment sponsors that we work with at the firm and who we work with. And so our entire tenet was to diversify away from the Magnificent Seven and go to a more equally weighted type of portfolio, which it did help us stomach some of the blow here by doing that. But those stocks sold off very sharply.
What's some of the rationale behind Trump's tariffs policies? Like, where's this coming from?
Well, I really think at the end of the day, he's using it as a way. I think I've heard 50 countries want to come to the table. There's 70 countries.
I heard up to 70.
Yeah, I've said 70 countries. The numbers are bouncing around. I mean, that's a lot. That's a lot of negotiation to do. And I really think he did this as a way to get everybody's attention. I think he wants to change the post-World War II agreements that we've had in place. And then I also know that there's a bill up in the Senate to talk about prevent Trump or take away the power of the president, which was granted in 1974, to actually do tariffs. So that was almost 50 years ago that we're talking, more than 50 years ago, that policy was created. But unfortunately, the president can also veto that. And we don't have enough of people in the Senate. There's 53 Republicans in the Senate right now out of 100. I don't think there's enough of, it's going to take about 66, right? So 2/3 majority to veto-proof that vote. I don't know if that's going to happen.
These retaliatory tariffs, how have they, with trading partners such as the European Union's 50% tariff on American whiskey, or Canada's 25% tariff on spirits, how they impacted our economy here in the U.S. and the market sentiment is what?
Well, I think because it's so new, more than anything, we haven't felt the true impact of it. I think what it does is it kind of kills the animal spirits of the economy. It hurts the predictability for businesses to plan and to budget properly. It's a level of uncertainty that if you're going to do a 5-year plan, you don't know what the tariffs are going to be. You want your variable costs in any business to be as minimal as possible.
Well, everybody wants predictability.
Yeah. And as a result of that, it's very tough to predict where you're going to get your products from and what products are going to be allowed in the country. And I know they just liberated, things like computer chips and some technology and things that are super important and essential to the economy. But on the other side of the equation is the Chinese also don't want to bring over any of their rare earth minerals anymore. And that could be a big deal for some of the things we need in a modern economy.
All the more reason for us to work a deal with Ukraine because they owe us a lot, and we're looking at rare earth minerals from that nation.
Yeah, it would be the Ukraine, or even Canada was another one that we started off on the wrong foot when started off with tariffs, and we upset them very much. So I'm hoping that the dust settles, and I'm really hoping that people look at the big picture. And I think if you can get the rest of the world together And I think that's what we needed to do. If we could have done this differently, I would have basically gotten renegotiated or reaffirmed the deal that we had with the Mexicans, Mexico and China and Canada, and gotten that solidified. Then I would have gone to the European Union and had my negotiations with them. And when you have the rest of the world on your side, instead of, fragmented as it is, if you had the rest of the world on your side playing ball, then the rest of the world can then somehow gang up on China and say, hey, that would have been the better play, because China's got to be the last negotiation.
It sounds like you approve of what Trump has done, just not necessarily his method of going about it. Back on April, a couple of weeks ago, we had Liberation Day, April 2nd. The tariffs were described as sparking panic selling, and it was happening globally. So what specific aspects of that announcement led to some of the comparisons with the this historical market crisis, such as you think back in 1929, the crash in Wall Street, and 87, I think there was another one. How does this compare with that?
It was an incredibly sharp sell-off. And then not only we have that insanely sharp sell-off, I mean, we're just, insane, major sell-off. I've seen it before, though. I lived through 2008. I've lived through the dot-com bubble. I've seen what sell-offs are, but one thing I said to one of my clients, I said, you've never seen everything. That's the beauty of this business that I'm in. You've never, ever seen it all. And I'll say one of the craziest things happened during COVID when oil, remember, it was like negative $35 a barrel. And I was just like, this is insane. And that's exactly what I was saying with this stock market sell-off. I mean, everybody was, this is the biggest panic sell. This is a major panic sell. And I think a lot of people just pulled the trigger and bailed out of the market. Well, it's what you're not supposed to do. And it was a wild ride. And I've gotten calls from clients that I had never heard for when the markets are choppy. But this was pretty scary. And I was like, cooler heads are going to prevail. You're going to hear announcements that countries are going to come to the table, that you're going to start talks of negotiations. So I bring it like this. There's several other things I could talk about here, like, for example, interest rates. We've had elevated interest rates now for 2 years, and it still hasn't grinded the gears of the economy. It hasn't slowed anything down yet. Eventually, that's got to slow down your economy. That's what they were there for, to kill inflation.
But you also said a moment ago you don't anticipate the Fed reducing, because they're not a big fan of Trump, so you don't anticipate them lowering the interest rates.
I don't think they're going to do it because they want to see what the inflationary potential impact of the tariffs are going to be. And I think they're pretty happy where they are right now. And I think we would have to see a very sharp decline in gross domestic product. It would have to probably go negative before I think they're really willing to get aggressive. Right now, they're playing a wait and see. The Fed is designed to be a steady hand. It was never designed to be political. And I feel if they were to ease right now, it would create the appearance of them supporting Trump's policies. And I think that could also create more inflation in the future. So that's a big issue.
Folks, you are listening to On the Mark along with Mark Papa. I'm Gary Byron. You can check out his website for Financial Resources Group. It's www.f as in Frank, rplan.com. And write this phone number down. It's 860-657-8380. More importantly, use that number. And if you missed any of those points of contact, I'll make sure I repeat them more towards the end of the show. You were talking a moment ago, Mark, about market sell-off. Well, the U.S. Treasury market, they experienced a significant sell-off with a 30-year Treasury yield jumping 54 basis points to 4.92% in just 3 days. Yeah. So what factors, such as declining trust in U.S. bonds or margin calls, what drove to this unprecedented movement?
That is a great question that everybody's trying to figure out because we don't know if that was the Chinese selling off treasuries. I think I was listening over the weekend to last weekend Behind the Markets. Mm-hmm. It's a Wharton School, Wharton Radio, XM Radio. I would encourage everybody to listen to that. Behind the Markets, Jeremy Siegel. It's Dr. Jeremy Siegel, Dr. Jeremy Schwartz, two people who I absolutely look up to and listen to. Highly credible professors, PhDs at Wharton. There's $10 trillion in treasuries globally, and that $10 trillion in foreign ownership. So somebody sold. Somebody said, "Hey, we're going to unload your treasuries," and I think it was just a way to scare us a bit. But there was also, people who borrow. There was also a group of hedge funds too who also got some margin calls based on that move that had to liquidate as well. So I don't think they had that kind of. The hedge funds don't have that kind of power. It had to be a very large entity that sold off, and basically it shows a lack of confidence in our U.S. Treasury as the.
I'm curious, though, but why? Why did U.S. Treasuries fail to act as a safe haven asset during this market? And how does this compare again to these historical roles in times of crisis?
Yeah, I mean, because people again I think they lost confidence, or there's just a lack of confidence in the Treasury being the safe haven that it is. I mean, China and Japan. I think China is. $1.2 trillion they own in treasuries, or $800 billion in treasuries. Japan has $1.2 trillion. So you just don't know. I mean, they maybe wanted to take some chips on some cards off the table.
Maybe.
I mean, and not to mention though, rates did people get a little bit scared. Rates did gravitate lower in because people were buying bonds instead of stocks in the stock market sell-off. And so maybe somebody took a profit, but I mean, that's a pretty big profit.
We saw we heard Treasury Secretary Scott Bessent describe the bond market sell-off as a normal deleveraging. So do you agree with that assessment, or do you believe that there were some systemic risks at play?
I think he carefully worded his statement.
I think so, too.
I think that was I call that a very nice way of sugarcoating things, because, that is a historic move, especially in a 3-day period. I mean, think about it. And the Fed, cuts a quarter point here, quarter point there. That's a historic move that I don't think, again, there'll be case studies written about that day, without a doubt.
The S&P, they lost approximately $5 trillion in market value in just 2 days following that tariff announcement. So what do you think were the key drivers behind this? I would call it a rapid decline in overall market valuation.
Well, I would say that the tariffs did push it off a cliff, but there's also some other things in the marketplace. Again, the AI trade, the artificial intelligence trade. I want to go back to the White House announcement by Larry Ellison when they talked about $500 billion in data center spending. I think from that day, you'll see the AI trade peaked and it started to unwind a bit. And from that point, we saw not only did it start unwinding, but then you had an announcement that DeepSeek, who is a Chinese AI player, can do it better, cheaper, faster. In that argument, you started seeing the AI trade sell off as a result of, hey, these guys can do it better, cheaper, faster. That means, hey, maybe we don't need so many NVIDIA chips. Maybe we don't need so many data centers to fund this. They can do it for a lower cost. And when you look at the big picture, that company still needed. They're still, far away from ChatGPT. They're still far away from some of the other AI platforms, and they're coming out, new ones every day. But it still takes into question. But you got to look at the big picture. If they can do it cheaper and faster, that means you're going to have these tools available for more and more people. And that means the demand for those chips actually should rise, not go down.
Well, you had Goldman Sachs recently raising their recession probability to about 35% for 2025. How are investors adjusting their portfolios to account for lower growth projections and higher inflation expectations? What are you doing with your clients? And do you foresee a 2025 recession?
Well, I think there's ultimately a flight to safety. Recessions happen naturally. Let's face it. It doesn't matter who the president is. I would say that we should have had a recession already, but we had massive government spending that fueled the market during the Biden administration, 23 and 24. There was massive government spending, massive deficits, right? We're paying $908 billion in interest on our government debt. So think about that. That's more than the defense budget. So there was massive spending while the feds were raising rates. So the rate hikes couldn't really have any impact. The other reason those rate hikes also didn't have an impact, and they should have, is that most people's mortgages were refinanced down at 3%, 3.25%, 2.75%, and now new mortgage rates are 6%. Most people didn't feel that because their mortgage was already locked in at a low rate. So when you raise rates on folks, right, that it hurts, but it didn't hurt the consumer at all. But I would say a lot of it had to do with government spending, and how that gets calculated into gross domestic product was a huge stimulus to the economy. And we were living on a sugar high. Now we're trying to cut spending. We have DOGE. We have attrition. We're trying to thin out the ranks of our government, trying to keep spending under control. And that means less government spending, and that also has an impact on the economy. But it's also less inflationary. So we have to see, basically the ship is just turning in a different direction. And I think that there is a probability of a mild recession as a result of some of these changes if they get implemented. But if they pass the Trump tax cuts as well, that's also very stimulative.
I've only got about a minute left. Final question for you.
Sure.
Given the reported $4 trillion loss in global stock markets, how do you assess the risk of a global recession? And since you think that there might be a small chance of it, and what parallels do you think you can draw between the past events? Like, remember back in 2008, the financial crisis in the housing market, and we were giving mortgages to everybody. Mm-hmm. And then more recently, the 2020 COVID-19 crash. I've got 1 minute.
Well, ultimately, I don't really see any bubble in the economy right now. I don't see anything I think things have sold off naturally, which they should have. I think probably overdone a bit. Mm-hmm. I think people did panic too much, and I'll tell anybody, if you can have the staying power, you should just stay the course. I tell it, every sell-off is, again, there's never one reason why the market sold off. It's always a bunch of different things. So it's like you have a lot of dark clouds. Eventually, they're going to run out of rain, and the sunshine's going to come back. Mm-hmm. And that's what I'm seeing. I'm fairly optimistic that this is going to be a tough road. And it could be a tough road this year, but I think the long term, if we get our trade policy the way we should have it, and I think President Trump and will do a good job at that, then you're going to see a global economy that's booming. Europe is already starting to benefit from some of the trade talks. Europe was very undervalued, so if you have a globally diversified portfolio, which we do, so we're not losing. We didn't get beat up too badly in Europe.
All right,
we did pretty good. So,
folks, if you've missed any portion of this show or past episodes, there's a couple of things you can do. You can go to YouTube, because Mark's got his own YouTube channel. Just type in Mark Papa, MarkPappa 5207, and you'll get his Mark's YouTube channel. You can also go to his website, and there's a link there that'll take you to the YouTube channel. The website for Financial Resources Group is simply www.frplan.com. That's F as in Frank, rplan.com. And to schedule a consultation, there's never any obligation. Sit down, get the checklist done with Mark Papa, 860-657-8380. Once again, 860-657-8380. For Mark Papa, I am Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.